Like recently, like I had a client and I decided like, okay, let us use ETF for the entire portfolio. Like I had a big dilemma when it comes to fixed interest because now I don't want to get into long duration bonds. And if I go into fixed interest like ETFs, like I'm really stuck because like I'll be using Vanguard and stuff and I'm using like a long duration bonds. And like, how do you tackle that one? Because I want to be in short duration bonds now. Like, it's how do you tackle this?
That's a great question. How do you tackle the issue with bonds? I totally agree with you. I think the outlook is clearly changed towards at least a discussion about interest rates not staying at record lows. We haven't got to the discussion about interest rates going up yet, but they will. And in that environment, in a rising interest rate environment, what happens to bonds? You know, as night follows day. They're going to lose, value in the principal. They're going to lose value, and we face that dilemma as well. So again, we're asset allocation based. We've got, say for instance, a balanced investment. We've got 50% we need to allocate to defensive assets. Where the hell do you put it? We consciously made the decision a number of months ago to shift our clients away from those bond investments, and we didn't want them in cash because you earn very little. And so we do have them parked for a large chunk of that in term deposits. The yield is not particularly great, but the purpose of that portion of the portfolio is not to chase yield. It's defensive nature if things go wrong. So we are grappling with that exact same dilemma. I think a lot of the industry funds are grappling with it as well. I was talking to Australian Super and saying the same thing. For my clients in Australian Super, where for their defensive portion, what can I put them in? You know, I don't want them in the bonds in a rising interest rate environment. What does that mean? I put it in cash where they earn very little? What are the options there? Why don't you have term deposits that they can put it into? So I think that's a common issue across the industry. And I don't think there's anything in ETF land that actually solves that dilemma. So we need to go looking elsewhere. And to be honest, TDs is the best proxy that we've come up with so far. Say again? Yeah. Well, there you go. You can go the active side as well, and clearly with a managed fund that takes a shorter duration, then that's clearly can be advantageous. Any other questions? Yeah. Ooh.
Are you using platforms still? Are you?
Yep. Okay. Good question. What
software?
What else are we using? We are using. We've signed up with Australian Super, so we have a number of clients. I think there's about a dozen AFSLs in the country that have signed up with them. So we have clients. The best way for them, and appropriate for their circumstances, in industry fund. We have other clients who are on platform. An SMSF is not appropriate for them, and I think increasingly over the next couple of years, as a lot of SMSF clients age, and perhaps one passes away of a couple, I think there'll be a big issue with SMSFs not being appropriate for a lot of those people as they age, and so potentially back into either industry fund or into retail platform territory. And then for those off platform, we have a lot of SMSF clients who are trying to escape the institutions. They've run away from being on a platform at wherever, and for them it's an anathema to pay those sorts of fees. And so for those guys, yes, we've got them on broker, and then we also have other unlisted investments. A lot of them have property and so on and so forth. We use one of the guys who I think is sponsoring today, Premium, to overlay the valuation. There you go, Nat, free plug for you. And that's how we're managing the process. But that is, for us, a continually evolving. We're always looking for best practice that can help us improve our business as well. I think there was a question behind you as well.
Yeah, just please comment on this. I think you said the relativity between cash, term deposit, and bonds, and you've taken away from bonds and maybe preferred term deposits. My question is that if bonds, I think David said that the corporate bond rate is about 4%, and if you had to use someone that said PIMCOs, where they can get international exposure and you get the currency hedging, I attended something yesterday that said that and if you keep the bond to maturity, you're getting something like a 6.3% return. To me, that seems to be sensible, in as much as if you're taking a long-term view of some of it, that might be acceptable rather than taking it away from term deposit and putting in a term deposit, because I think the term deposit rate today is about under 4%. So it would make sense if you did make a bond investment at some stage to keep it to maturity and get that long-term advantage, and then do a portfolio by taking the equity side of things to balance out what you want to get.
Yep, I mean,
Please
that's a great question. What I'd say in response to that is the core and satellite approach is the perfect way of addressing that. The core, you put the core in place, and then where you've got a high conviction idea like that, you can put it in any form you want, whether it be via PIMCO or Vanguard or whoever. The core and satellite approach, rather than the passive or the active approach, enables you to take high conviction ideas such as that and place them within the overall portfolio as well. That's a valid approach to that situation. I think bonds, my personal view is I think bonds are going to be in for a bit of a struggle over the coming years, but that's my personal view. So there you go. Yep.
You mentioned the transition when talking about the transition from active to more passive, you
Yep.
mentioned you made a few mistakes along the way. Just in the interest of time, give us your number one. What's the biggest mistake that you'd change if you were doing it again in terms of managing that process?
I think we'd get the admin a bit sort of sorted beforehand. There's a lot of administration that goes on in a platform that you sort of take for granted. It enables business efficiency, scale, and so on and so forth. A lot of the work that we took on, perhaps if we had brought in an external party, not that we're going to give other companies here plugs, but yeah, implemented portfolios. Those sorts of firms can help you reduce the administrative burden and the errors perhaps along the way. That we learn a lot out of that. We actually understand our business a hell of a lot better for having made those mistakes. So I don't say it's complete negative, but it did mean that it took longer than potentially it could have if we outlaid the fees and outsourced that and learnt from the outsourcer. Any other questions? One thing I do want to leave you guys with, I think one of the greatest weaknesses of ETFs is that they're boring. You can tell a story about an ETF, put an article in the paper, and you know what? It doesn't change the next week, the week after, so on and so forth. The press struggle with ETFs because you can't make it exciting. It's just the same. And so that's why I think one of the strengths that active investing has over passive is that fact that there's a sense of excitement, there's a sense of investor activity, enjoyment, or that they correlate, or they in their minds they associate movement, action with returns. So I suppose my challenge is for the panel is, how do you make ETFs sexier? How do you make them? How do you keep telling stories about ETFs that isn't the same as last year? So I'll leave that to those guys when they're up next. Outsource it.